Welcome to the world of Test Portfolio XSX. This video was created with the help of artificial intelligence. It provides a weekly summary of key economic events. The featured portfolio is simulated, fictional, and reflects my personal perspective on recent market developments. My main goal is to explore whether the S&P 500 can be outperformed. To do this, I compare the performance of three different portfolios: my own fictional portfolio, an S&P 500 portfolio built using a lump sum investment strategy, and an S&P 500 portfolio built using the dollar cost averaging method. This video reveals which strategy performs best and why. Disclaimer: this video does not constitute financial advice and does not recommend the purchase or sale of any financial instruments. I do not take responsibility for any potential inaccuracies or errors that may occur. Ready to get started? Let's go. Inflation data, geopolitical tremors, and another Chinese intervention. Wall Street seemed to hold steady, but beneath the surface, a serious realignment has begun. Let's look at what happened this week that really matters. The most important event of the week was the US inflation data. The June PCE inflation report came in lower than expected, which immediately triggered speculation about rate cuts. Core inflation slowed to 2.5% year over year, closer to the Fed's target than at any time in the past 2 years. As a result, the market priced in nearly an 80% chance of a 25 basis point rate cut in the September meeting. The dollar weakened, the bond market moved upward, and the S&P 500 approached another all-time high. Meanwhile in China, new economic stimulus measures were announced. The central bank launched a targeted lending program for the tech and infrastructure sectors. The goal is to offset the negative spiral caused by the persistent weakness in the housing market. Chinese stock markets rose on the news, and the positive sentiment spilled over to US tech stocks as well, particularly those with exposure to Asia, such as Nvidia, AMD, and Apple. On the geopolitical front, the second round of Iran's presidential election was notable, where moderate candidate Pezeshkian won. While direct US impact was limited, the oil market temporarily calmed and Brent fell below $82. This indirectly eased US inflationary pressure, as energy prices are now pulling the indices downward. From Europe, the most significant event was the surprisingly weak German IFO index. On its own, this wouldn't warrant attention, but US markets still reacted because the weak German data highlighted global demand weakness, which in turn affected pricing of US industrial exporters such as Caterpillar and Boeing. The S&P 500 opened around 5,510 on Monday and climbed above 5,570 by Friday evening, about a 1.1% weekly gain. The Nasdaq performed even better, jumping over 2%, mainly thanks to tech sector momentum. The Dow, however, stagnated and even dipped slightly on Friday, as traditional industrial stocks couldn't benefit from the signs of weakening global demand. Sector-wise, tech led the way, especially AI-related companies. Nvidia, Supermicro, and Palantir all rallied again. In contrast, energy and financials underperformed. Bank stocks were dragged down by rate cut expectations, while oil stocks weakened due to the Iranian election effect. This week once again reinforced the narrative that the Fed is nearing a turning point, and the first rate cut is just a matter of time. The market is increasingly pricing in the soft landing scenario, where the economy avoids recession while inflation fades. But is this an overly optimistic view? Or are we truly headed for an ideal outcome? What do you think? Will the Fed really cut rates this year, or is this just the market's self-fulfilling desire? Let me know in the comments. If you liked this recap, don't forget to subscribe to the channel and check out the latest video on AI stocks, now with a dedicated segment on NVIDIA's newest announcement. A celebration for the AI stars and a reality check for the old guard sectors. That sums up Wall Street this week. Advertising and cloud giants lit up the scoreboard, chip makers and oil service names wobbled, and rails kept momentum alive hauling coal. Let's dive in and see who landed on the podium. Alphabet, the engine of search and cloud, beat expectations with $96.4 billion revenue and $2.31 EPS. The stock closed up 4%. Google Cloud's monetization of the Gemini model and AI-driven ad optimization stole the show. Texas Instruments, the quiet champion of everyday chips, turned in $1.41 EPS and 16% revenue growth. But a muted Q3 outlook pushed shares down 3%. Intel, the veteran of processor manufacturing, posted a surprise loss, 10 cents non-GAAP EPS, $12.86 billion revenue, and cast fresh doubt on its IDM strategy. The stock slid 8.5% on the day. Snap is still searching for footing. A preliminary trading update showed barely any revenue growth as ad spending cooled, knocking the stock about 6% lower. Official EPS lands Monday. American Express, the king of premium cards, crushed it with $17.9 billion revenue and $4.08 EPS, yet the share price was flat as it boosted loan loss reserves. Visa reports next week, leaving the market guessing where consumer spending trends stand. Thermo Fisher, the lab and diagnostics multi-service provider, delivered $10.85 billion revenue and $5.36 adjusted EPS. The stock bounced 2% after management raised full-year margin guidance. AbbVie issued only early guidance late in the week. Its full Q2 report was bumped to Monday, leaving post-Humira portfolio questions unanswered. Halliburton, the oil field mechanic, matched consensus at $5.51 billion revenue and 55 cents EPS. But softer pricing sent shares roughly negative 4% intraday. Kinder Morgan's Thursday print showed EPS up 23% year over year, proving gas midstream remains solid, but the stock barely budged. Coca-Cola, the fizzy drink empire, logged $12.5 billion revenue with 1% organic growth. Shares slipped 1.5%. McDonald's, the quick-service superstar, met consensus with $2.67 EPS, but $5.96 billion revenue missed the $6.17 billion target, sending the stock down 3%. GE Vernova, the energy infrastructure builder, reported $9.1 billion revenue, plus 11%, and a 5.4% net margin, then raised full-year targets. Shares jumped 4%. RTX, Raytheon, Aircraft and Missile Systems House, posted $21.6 billion revenue and $1.56 adjusted EPS, but trimmed its profit forecast after Trump doubled steel and aluminum tariffs. Stock, 2%. Union Pacific, the west-to-east freight rail, beat the $2.91 consensus with $3.03 EPS. Revenue of $6.15 billion was a hairlight, but better coal and grain volumes lifted shares 2%. AI-driven tech titans, Alphabet, set a positive tone, while legacy hardware, Intel, dimmed the euphoria. Consumers are still swiping, Amex, but basket size, Coca-Cola, is no longer expanding rapidly. Oil service and industrial players are issuing more cautious outlooks thanks to tariff pressures. Net-net, tech led the charge, but the market is picky. No AI growth, no mercy. Which earnings shocked you more, Alphabet's liftoff or Intel's nosedive? Tell us in the comments. If you found this recap helpful, hit like, subscribe, and share it with a friend so they don't miss this week's earnings stories. Nothing has changed in the strategy, everything remains the same. Let's see how our three strategies have evolved compared to the S&P 500. Strategy 1, lump sum, one-time investment of $15,000 in S&P 500 ETF on January 2nd. Current performance, 8.62%. Strategy 2, dollar cost averaging, $1,250 monthly investments. This gradual approach shows 9.28% performance, slightly outperforming lump sum. Strategy 3. My fictional portfolio launched March 19th with individual stock picks. Current performance, 30.44%, significantly outperforming both strategies. These metrics exclude broker fees and taxes, reflecting only market-based price movements. The results speak for themselves in this ongoing comparison. Thank you for joining us on this economic journey with Test Portfolio XSX. If you enjoyed this weekly recap of the key events and our portfolio's performance, give it a like, subscribe, and join us again next week as we review the latest market moves and the progress of our investments. Disclaimer. This video does not constitute financial advice and does not recommend the purchase or sale of any financial instruments. I do not take responsibility for any potential inaccuracies or errors that may occur.